If you've ever wanted to grow your money without constantly watching the stock market or guessing which company will go up next, this is for you. Let's keep it simple. If you just invest $200 a month into a solid ETF like VOOO, which tracks the S&P 500, and you stick with it for 30 years, you could end up with nearly $400,000. Double that to $500 a month, and you're looking at almost $1 million. That's with dividends reinvested and a historical average return about 10% per year. And the best part? You don't need to be a stock picking genius. You don't even need to check the market every day. You just need to be consistent, stay patient, and let time do the work. In this video, I'm going to walk you through exactly how ETF investing works, why it's perfect for beginners, and how you can start with just a few clicks. By the end, you'll know how to build long-term wealth with confidence, without the stress. But first, what exactly is an ETF, and why is it such a powerful tool for investors like us? Let's break it down. Part 2. What is an ETF? So what exactly is an ETF? ETF stands for Exchange Traded Fund. Sounds fancy, but it's actually super simple. Imagine this. Instead of buying just one company's stock, like Apple or Tesla, an ETF lets you buy a basket of companies all at once. This basket can include dozens, hundreds, or even thousands of companies, all bundled into one fund. And here's the cool part. You trade ETFs just like a regular stock. You can buy or sell them during market hours anytime the stock market is open. For example, an ETF like VOO tracks the S&P 500. That's 500 of America's largest companies, all in one single investment. So instead of betting on one winner, like Netflix or Nvidia, you're spreading your investment across a broad range of companies. That means less risk and usually more stability. Now that you know what an ETF is, let's talk about why ETFs are one of the best investment tools for beginners and how they can help you grow your wealth without the stress of stock picking. Part 3. Why ETFs are great for beginners. All right, so why are ETFs such a big deal for beginners? Let me break it down into 6 powerful reasons. And trust me, once you understand these, you'll see why so many smart investors love ETFs. 1. Diversification, a built-in safety net. When you buy an ETF, you're not putting all your eggs in one basket. You're spreading your money across dozens, sometimes hundreds of companies. That means if one company has a rough year, your entire investment doesn't crash with it. Think of it this way. Buying one stock is like betting on one horse. Buying an ETF is like betting on the whole race. 2. Low cost, keep more of your money. Most ETFs have super low fees, some as low as 0.03%. That means for every $1,000 you invest, you're paying just 30 cents a year. Compare that to many mutual funds charging 1% or more. That's $10 per $1,000. Over decades, that fee difference adds up to tens of thousands of dollars. 3. Easy to trade, just like a stock. You can buy and sell ETFs anytime during market hours, just like a regular stock. It's fast, flexible, and gives you control over your timing. No waiting until the end of the day, like with mutual funds. Just click and go. 4. Access. Invest in what you believe in. Want to invest in the whole U.S. stock market? There's an ETF for that. Tech sector? Got it. Renewable energy? Global bonds? Even gold? There's an ETF for that too. No matter your interest or goal, there's likely an ETF that fits. 5. Transparency. Know what you own. Most ETFs update their holdings daily. That means you always know exactly what's inside your investment. No secrets, no surprises. Some actively managed funds don't do that. ETFs? They're all about openness. 6. Tax efficiency. Keep more gains in your pocket. Thanks to something called the in-kind redemption process, ETFs typically generate fewer taxable events. Translation, fewer surprise tax bills from your investments. So to recap, ETFs are diversified, low-cost, flexible, transparent, and tax-friendly. That's a lot of wins, especially if you're just getting started. Now, as good as ETFs are, and they really are, nothing is perfect. So before you jump in, let's go over a few things you should watch out for to avoid surprises and set yourself up for success. Part 4. What to watch out for. Here are a few things to watch out for before you dive in. Expense ratios. ETFs are known for low fees, but not all ETFs are created equal. Some charge just 0.03% per year, while others go over 1%. That might not sound like much, but over 10 or 20 years, that difference can eat thousands out of your returns. Liquidity and bid-ask spreads. This one's often overlooked. If an ETF doesn't trade much, you might pay more just to buy or sell it. That's called a wider bid-ask spread, and it's like paying a hidden fee. So stick to ETFs with higher trading volume. They're easier and cheaper to trade. Market volatility. During big market swings, ETFs can sometimes trade at a premium or discount compared to the actual value of what's inside. It's rare with big ETFs like VOO or VTI, but it's something to be aware of, especially in fast-moving markets. So yeah, ETFs are great. But like any tool, you need to know how to use them wisely. Keep costs low, stick with well-known funds, and understand what you're buying. Part 5, how to start. 3 simple steps. All right, now that you understand what ETFs are and why they're so powerful, let's talk about how to actually get started. Don't worry, this part is way easier than most people think. You only need 3 simple steps. Step 1, open a brokerage account. This is your gateway to investing. Think of it like opening a bank account, but instead of holding your cash, it holds your investments. I personally recommend Charles Schwab, Fidelity, or Vanguard. They're safe, reliable, and built for long-term investors like you and me. You can set everything up online in less than 15 minutes. Step 2, pick your ETF. You don't need to pick the perfect one right away. Just start simple. For most beginners, a broad market ETF like VOO, which tracks the S&P 500, is a great place to begin. As you get more comfortable, you can explore other ETFs that focus on things like tech, international markets, clean energy, or dividend-paying companies. Step 3, decide how much and how often to invest. You don't need to start with thousands of dollars. You can begin with $50, $100, whatever works for your budget. The most important part? Set it on autopilot. Automate your contributions monthly so you don't have to think about it. And here's the key. You don't need to time the market. You just need to be in the market. So now you've opened your account, picked your ETF, and made your first investment. What's next? Well, this is where the real magic happens. In the next section, I'll show you what to actually do after you've bought your ETF and how to build wealth consistently over time. Part 6, what to do after you buy. Now that you've made your first ETF purchase, what comes next? Here are 3 key habits to help you build long-term wealth and stay on track. Stay consistent. The most powerful habit you can develop is investing regularly, ideally every month, even if it's just a small amount. This steady approach, called dollar cost averaging, helps you buy more shares when prices are low and fewer when prices are high, smoothing out the ups and downs over time. Don't try to time the market. Trying to guess when the market will rise or fall is extremely difficult. Even the pros get it wrong more often than you think. Instead, stick to your investment plan, keep adding money regularly, and focus on the long-term growth. Keep learning. It's a good idea to check on your ETF holdings from time to time and stay informed about market trends. As your knowledge grows, you might decide to add other ETFs or adjust your portfolio, but don't rush. Build your confidence step by step. And speaking of building your portfolio, let me share a quick list of some of the best ETFs for beginners that cover a wide range of markets and investment goals. Part 7, quick list, best beginner ETFs. Before we wrap up, here's a quick list of some of the best ETFs for beginners to consider: VO or SPLG. These track the S&P 500, giving you exposure to 500 of America's largest companies. VTI covers the entire U.S. stock market, including small, mid, and large cap stocks. QQM, focused on technology and growth companies, great if you want exposure to innovation. SCHD, a dividend-focused ETF, perfect if you're looking for steady income as well as growth. VXUs gives you access to international markets outside the U.S., helping diversify globally. Now that you know some solid ETF options, let's talk about how consistent investing in these funds can help your money grow over time. So here's the big takeaway. Let your money work. If you start investing just $200 a month in an ETF like the S&P 500 over 30 years, you could end up with nearly $400,000. And the amazing part? You only put in about $72,000 of your own money. The rest comes from compound growth and reinvested dividends. That's the real magic of investing consistently over time. ETFs make this simple, affordable, and accessible to everyone. No need to pick individual stocks or try to time the market. If you found this video helpful, please give it a like. Got questions or excited about your first ETF pick? Drop a comment below. I love hearing from you. And don't forget to subscribe for more beginner-friendly investing videos to help you build your financial future step by step. Thanks for watching. Have a nice day.